Many investors and the media ask whether there's an AI bubble. But that's not the question. We know that stock markets are highly valued. The numbers leave very little room for debate. My name is Michael Frommel. I'm a professor of finance. After 30 years of research at universities, central banks, and in the financial sector, I want to share my knowledge and provide you with the evidence-based insights to make better financial decisions. The CAPE ratio of 40 is historically extreme. The CAPE ratio is Robert Shiller's version of the price-earnings ratio, dividing current share price by the 10-year average earnings corrected for inflation. In other words, every dollar the firms have earned is traded at $40 on the stock exchange. The historical average is 18. The real question is not whether valuations are elevated. The real question is, what are investors really betting on? We saw similar extremes exactly 4 times in history: 1901, 1929, 1966 and 1999. And in all 4 cases, bad times for investors followed. In 1901, investors were captivated by industrial progress and economic expansion. There was a huge optimism about the future, fueled by industrial development and advances in science that were comparable to today. In 1929, massive speculation ended in a collapse. In 1966, extreme valuations were followed by years of disappointing returns. And in 1999, investors believed in a new technology which they assumed would rewrite the rules of finance. Different eras, different stories. But the same ingredient: extraordinary optimism about the future. Before we discuss what's going to happen next, we first need to understand why valuations are so high today. We are living through an AI boom, and with every technological revolution of this size, it comes with enormous promises. We know that AI will change our life and the economy, and we see that it already does. Economists have a name for something we often observe during such periods: the Solow Paradox. US economist Robert Solow famously observed in 1987 that we can see the effect of computers everywhere except in productivity statistics. The Solow Paradox reminds us that productivity and profits do not always follow innovation. Skeptics will rightly argue that AI is different from the internet era because we now require massive physical infrastructure: chips, data centers, energy. That is true. But this very reality makes this business incredibly capital intensive. It's not a software business with very low marginal costs. It's an arms race with an incredible need for physical capacity, requiring enormous and permanent investments. We will pick up this point in part 2 of the video again and have a look at what this arms race means. Don't fall for the trap. Subscribe and stay ahead. Thank you. The market assumes AI will become a powerful productivity engine. Perhaps it will, but remember, technology does not always create profits. Sometimes it creates lower prices. Sometimes it creates better products. Sometimes it just creates more competition. But none of these guarantees higher profits for the majority of firms. And competition can make durable profit margins surprisingly difficult to sustain. Now consider the mathematics. At a CAPE ratio of 40, the earnings yield is 2.5%. In simple words, that means every investor effectively receives 2.5 cents of annual earnings for each dollar they invest. At the same time, government bonds offer yields of close to 5%. The investors can now choose whether they invest in the risky stock market with a yield of 2.5% or in government bonds with a yield of 5%, and if they hold the bonds until maturity, hardly any risk. Still, investors opt for equity. And let's not overlook the balance sheet side. Many tech giants are financing their massive capital expenditure in an environment of significantly higher interest rates than we saw 5 years ago. While the growth of the 1990s was fueled by extremely low capital costs and the Goldilocks economy, today's profitability faces a direct pressure of rising refinancing costs. So if these expected productivity gains will not quickly enough translate into earnings, the debt pressure will become the bottleneck. So why should investors choose the riskier asset? There's only one answer. The CAPE ratio is based on past earnings. But investors do not buy past earnings. They buy future growth, and they expect this growth to be extraordinary. Depending on the assumptions in a dividend discount model, we can derive implied expected growth rates of 9, 10 or even 11% over the next 10 years. The exact number is not really important because historically, in the long run, growth rates were close to 2.5%. Even during the remarkable expansion in the 1990s, earnings growth rates averaged only about 7 to 9%. And yet, despite this remarkable growth, the whole situation ended in a major crash. Why? Because share prices rose even faster than earnings. And there's an important difference between the late 1990s and today. Back then, much of the optimism was still ahead of investors. Whereas today, investors seem to be pricing in already a major part of expected AI-induced growth, which means that prices require a substantial future growth above historical average. Whenever investors start paying for an extraordinary future, narratives become extremely important. Which brings us to some famous magazine covers from the dot-com bubble. To see how similar these narratives can be, let us play a short game. I will read 3 statements. Your task is simple. Decide whether these statements are from the dot-com boom or from the current AI boom. Let's start with quote number 1. The risk of overinvesting is significantly less than the risk of underinvesting. We must lead this transition. Is this dot-com or AI? That was Google's CEO, Sundar Pichai, in 2026, but it could have been said by any CEO around 2000 or 1999. Quote 2 is reshaping the fortunes of business, countries and people, leveling the playing field for everyone and driving the most significant economic shift since the Industrial Revolution. Dot-com or AI? This was the Cisco CEO, John Chambers, in 1998. The syntax is identical with the marketing of AI firms today. Quote number 3. The historic surge in infrastructure spending across the technology sector will generate strong returns. Again, the question is that dot-com or AI? That was Microsoft Chairman and Chief Executive Officer Satya Nadella, cited in a Morgan Stanley report in 2026. If you struggle to distinguish them, don't worry. That's exactly the point. History rarely repeats word for word, but investor narratives do. Today's valuations imply extraordinary expectations for the future. But that raises another question. What happens if these expectations are too optimistic? In part 1 of the video, we talked about valuations. History suggests that extreme valuations eventually resolve. In part 2 of the video, we will talk about 3 different scenarios for how the current high valuations may unwind. But valuation figures are not everything. We will also dive into a market event that can tell us as much about the future of the AI bubble as the dot-com bubble does, and about the probabilities of the 3 scenarios. And we talk about the erosion of innovation returns, a risk that many investors still underestimate. Subscribe and stay tuned. Thank you.